For the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
All right, everybody, welcome back to another Saturday Sendout from the Simple Side. I have a bunch of good stuff for you this week, including a new interesting trade idea and an entirely new format for the newsletter. We're going to get into all of it right now.
Welcome to the Simple Side. Market beating picks inside. There's no jargon and no time to waste. Join the Simple Side.
All right, like I said, we've got a new format this week. So we're going to jump into everything quickly. I'm not going to go too in depth today. It's going to be a quick podcast, just covering generally everything that we've got going on, of course, in our free section of the newsletter. So let's get into it. The big picture for this past week was a chop early, a rally late, and mega cap tech slumping midweek. Of course, we saw small and mid caps, homebuilders, and cyclicals outperform somewhat quietly. And Friday finished with a broad risk on pop. Of course, that was thanks to our Fed chair, Powell. So everybody give him a round of applause. Week to date, the Russell 2000 is up 3.3%. S&P mid-caps are up 2.6%. The Dow up 1.5%. The S&P 500 up 0.3%. And the NASDAQ down 0.6%. Rates, the 2-year is about 3.69%, which was down into Friday. The 10-year is about 4.26%, and the VIX eased back to about 14 after a Thursday spike. Of course, this coming after big news out of the Fed and that pop we saw on Friday. Jackson Hole anticipation dominated flows, with futures still leaning towards a 25 basis point cut in September. And all of that seems to be in full force. Labor numbers, job numbers, whatever you want to call them, are looking pretty rough. And so we do expect to see that rate cut in September. Further rate cuts for the rest of the year are going to be on a one-off basis. It's hard to know whether or not those are coming. This week, the leaders in moves were energy, financials, materials, and consumer discretionary, along with retail and home builders staying firm. The laggards were IT, information tech, semis, and mega caps, along with parts of consumer staples after big box wobbles. We did see some notable things happen this week, like Intel up 5% after SoftBank says they're going to buy in with $2 billion worth of equity. We saw ARM hire Amazon's AI chip lead. NVIDIA is working on a China-compliant Blackwell-based B30A while halting their H20 productions. And we saw Meta and Google ink a 6-year, $10 billion cloud pact. That is going to be interesting to see what happens there. Workday and Zoom and Intuit all lifted AI-tinted outlooks, and CrowdStrike was added to the IVE's AI 30. We had a lot going on in mergers and acquisitions, along with PE and financing as well. Thoma Bravo is circling Dayforce, and Goldman is lining up about $6 billion worth of debt for that. Nexstar is going to buy Tegna with a competing Sinclair proposal still swirling. Synovus is acquiring MEG Energy in an oil sands consolidation. And Soho House is near a take-private deal. Ross Stores is expanding their footprint, and multiple smaller deals are happening here and there, one-offs. You can go and look at those in the newsletter, thesimpleside.substack.com. Consumer retail, we saw Target with a modest beat. TJX and Lowe's were both firm. WH Smith flagged an accounting error, but it didn't seem to be a massive deal on their stock's price. Dick's Sporting Goods and Foot Locker announced a merger plan. We'll see if that ends up being allowed through, although I suspect it will be. Walmart initiated a shrimp recall across 13 states following FDA testing, and I'm sure you have seen the news stories on the radioactive shrimp. While this might have brought Walmart stock down just a bit, it's short-term news, and if you were looking for a time to buy into Walmart, that's probably a great time to get in. Always buy bad news, sell good news. More bad news on Tesla as UK lease pricing was slashed amid a poor week of July UK sales. They later raised the Cybertruck/Cyberbeast price with added features. NIO unveiled an ES8 refresh, Xpeng deliveries surged, and Boeing orders in China started to have a bit of an issue. Google was fined $36 million in Australia over search pre-installs, which is not going to be a big hit to their bottom line. Massimo sued U.S. Customs over Apple Watch import approvals, and Microsoft is going to be limiting China's access to VULN, V-U-L-N data. This is basically saying, like, they think that a lot of the hacks that Microsoft experienced in SharePoint were due to Chinese firms, and so they're limiting their access to be able to see kind of the back-end data, if you will. We also saw Visa shutter its U.S. open banking unit. So a little bit of stuff happening there as well. Breadth improved as investors rotated beyond mega-cap tech into domestically sensitive and rate-levered areas. Lower yields into Friday helped the pivot. AI infrastructure remains a secular anchor, but export control headlines keep semis choppy. What to be watching for next week? Of course, you want to see Powell follow through, and PCE next week for a confirmation of a September rate cut. China-compliant SKUs, data center order visibility, and optical supply tightness are all a big deal in the semiconductor world. It's going to be interesting to see how we handle all that. I don't think that the American people, the American government are too happy with China. So I doubt that there's going to be a lot of give and take there. That's about all that we had for this week and what I'm looking at for next week. Not too terrible much happening in the upcoming weeks. Post-Fed rate cut, it's all kind of simmered down a little bit, if you will. One thing that we did add to this week's newsletter is insider trade updates. I've been putting these in the paid subscriber spreadsheet that anyone who is a paying subscriber, of course, can go look at any point in time. And there's links all over to it in the newsletter, so you can find one and it'll take you over there. Of course, you're going to have to request access, and if you're a paying subscriber, I'll accept you. If not, I will reject you. We've got a few things here for the insider trade updates. We're going to be doing a buy the dip tracker. Every week, we're going to show you trades from the past week where insiders bought a meaningful dip in their company stock. A great example is Lineage, where the co-executive chair bought $500,000 worth of stock, and the stock is down 53% over the past year. Innovos Medical, ticker AVNS, had a director buy almost $660,000 worth of stock after a 51% one-year slide. EONR, or Eon Resources, saw a CFO buy $40,000 worth of stock after an 84% drawdown over the past year. Under Armour saw a director buy around $500,000 worth of shares after a 24% one-month drop, and then another $520,000 after a 25.95% drop. The 2 bites in 72 hours suggest real conviction and bias on long reclamation of a $5.20 price point for Under Armour stock. Quest Resource Holdings, QRHC, saw a director buy about $25,000 worth of stock at $1.70 after a 33% 3-month decline. EOLS, or Evolus, saw a director buy $200,000 at $6.82 a share, which comes after a 27% 1-month slide. And there are a few others here in the newsletter as well. We also track some whale buys, which are over $10 million in share purchases. We saw a director buy $312 million worth of Bosch Health stock, which they bought at $9. A bunch of other good stuff in there to go look at as well as some officer skin in the game, which is just executives opening up their wallets, which doesn't happen too often, but if they're increasing their holdings by a vast amount, it's definitely something worth looking at. For example, Valvoline, ticker VVV, their CFO bought $500,000 worth of stock, which increased their holdings by 2,456%. Very interesting to see there. We do have an interesting trade idea for this week, and it's going to be a small bet on Business First Bank shares, ticker BFST. I'm going to be buying Monday at market open, and the company to me is not being valued properly. BFST is a serial acquirer, having purchased multiple companies in 2024 and is looking to complete further M&A in 2025 and 2026. Net income at the bank has been growing at a 30% compounded annual growth rate, or CAGR, for the past 10 years. 30% compounded growth rate over the past 10 years. And you'd think that the stock price would be following suit, right? Well, that's entirely wrong. The stock has gone from its listing price of $25 a share to a whopping $25.4 per share, which does not seem like a 30% 10-year compounded annual growth rate to me. And I think a lot of people would agree with me on that point. The company also pays a 2% dividend and has multiple market whales quietly buying in the back end. They also increased their interest-bearing assets from 2023 to 2024 by 400,000 units. So they took interest-bearing assets, even if the interest rate drops a little bit, they added 400,000 units over the past year, and that means that they are going to be making a ton more money. The downside is that the company remains relatively volatile and doesn't show any obvious signs of a massive price jump. The hold may be a relatively long one, but I believe that it is going to reap long-term rewards. My investment play here is I'm going to take 20% of my cash on hand and invest it into the company over the long run. Given the large run-up that the company experienced on the Fed's rate cut announcement, I'm not going to go all in all at once. I just don't think that's a great play. I'm going to be investing 5% of my cash on hand with plans to DCA up to 20% on any given price dip that the stock experiences. If it never takes a massive drop, I'll be happy to see a 5% of my cash experiencing a large return. If it does take some price drops, I'll be DCAing, like I said, up to 20% and looking for that to run up in the long term. All right, now we get to talk about something really exciting, which is my portfolio performance. I'm going to let you go through and read about this in the newsletter because I wrote a bunch of good stuff in here that I want you to read. But paid subscribers, you now have access to go and copy trade all of my portfolios. You can do everything as well by looking at the paid spreadsheet if you can't access the copy trading platform that we partner with. If you don't want to pay the subscription that it costs, if you don't want to change your brokerage, any of that stuff, all of my portfolios are still going to be tracked in the paid subscriber spreadsheet. And there's a link in the newsletter that will take you directly to all of the new portfolio pages that I've developed in the spreadsheet. So go make sure you find those and pay attention to those. It's going to be very meaningful for us. Just know that when you go and look at Autopilot, which is our copy trading partner, you're not going to see the exact returns that I've experienced because I wasn't able to roll over the old returns from Double Finance into Autopilot. So it's all new returns, and the portfolios are going to look like they're only a month old. But of course, these have existed for years in some cases, and in other cases, a year-ish time periods. So just be ready to see the returns not look quite as great, but they're still quite impressive. Again, if you're a paying subscriber, you need to scroll down to the portfolio holdings and news section of the newsletter, which is where you're going to get links to all of the, I guess you can call it copy trade portfolios, my portfolios on Autopilot. And I'm going to say one very important thing. You need to sign up and get the subscription for the Autopilot today or Monday. I have a big discount, which Autopilot graciously allowed me to do. It dropped the price from $120 a year to $50 a year. So you need to go get in on that if you can. If you're already in the copy trading system as a paid subscriber, if you're one of the people that had early access, I'm working with Autopilot to see if we can give you a discounted rate next year so that you don't have to worry about paying extra. That being said, I think the portfolio over the past month is averaging a 9% return on one portfolio, 4% on another, and 4% on a third, which means if you have just around $1,000 invested in each portfolio, you've already paid for the annual subscription for that service. So it's definitely worth it. It's going to make your life a lot easier. You're not going to have to make trades, but you can keep up with everything in the paid subscriber spreadsheet. I think that is what I'm going to leave you with for this week. Just go through the newsletter today. There's a lot of good stuff in there. I talk about my portfolio strategies and updates, some new bets that I'm making, the portfolio holdings and the news and all that stuff. We also have continued the weekly picks. So those are at the very, very bottom of the newsletter now, but those are still there if you're looking at trading those. And I will be seeing you next week.